Everybody, I'm Conrad Everhard, one of the founders of Flatiron Law Group. 60 seconds on Flatiron because a lot of you already know us. We're an M&A, private equity, and deal boutique. We're populated by former big law partners, and we're active in the middle market tech space, the M&A space, principally tech, but not only tech. Also, we're fairly industry agnostic. Um, we're a pretty innovative place for those who know us. Our calling card, our principal innovation is that we price ourselves on a fixed fee basis. So we do fixed fee M&A and private equity. We do that by, obviously controlling our costs and the creative way we deploy labor, but we also do that by leveraging our own proprietary deal tools and platforms that allow us to mechanize and bring efficiency to the process. We call it Deal Driver. Lenny will mention that during his presentation. I think we're a pretty cool place. If you want to learn about us, reach out. Let me introduce our eminent guest speaker here, John Sternfield of Nfluence. John is one of the veteran bankers of Silicon Valley, over 35 years. John has been, his specializes in enterprise software, IT services, customer engagement. He's been head of tech at Cantor Fitzgerald, at Pesky Pruitt. Right now, he's managing director and head of communications at Nfluence Partners. We did a cross-border transaction, a telecom transaction with Nfluence and John last year. They sold Blue Danube to NEC. John is an excellent cook, and he's also a biker. John, did I cover everything?
Well, I don't know about everything. I've been doing it a long time. So we actually just figured out 35 years is probably closer to 45 years. But I started back in New York and with LF Rothschild, which was one of the earlier tech-focused, IPO-focused investment banks in the late 70s. I was in a lot of different functions within investment banking, from trading to institutional equity sales to venture and private equity coverage. The last 20 years have been focused in pure advisory, which is M&A and private equity capital raises for the most part. We do some private debt raises. And as Conrad mentioned, the focus is TMT. For my focus, and TMT is telecom media technology. And my focus is the two T's for the most part. One of our partners is focused on the media part of things. Nfluence is a boutique investment bank. Investment bankers never die. They just move on to different platforms. And we were started by 5 like-minded managing directors who'd been at larger platforms, focused primarily on M&A and capital raising, mostly equity capital raising. The M&A part used to be mostly sell side, but we're now doing a number of buy side transactions, although those are fewer, and those are normally very large companies. So one that I've got going on right now is, for instance, a $2.5 billion publicly traded company that does about $800 million in revenue and $100 million in EBITDA. And so, because the point is, for both capital raising and buy side M&A, you can provide great advice, but it's up to the client to pull the trigger. So we try to limit it to folks that we know are incented to get deals done. We do have, as Conrad mentioned, we did a cross-border deal. We kind of punch above our weight when it comes to cross-border. When I ran comm at Piper Jaffray, I also represented the firm in their Israeli practice. Israel, as you can imagine, has a lot of technology coming out of it. If you don't know, a lot of folks are in a certain group within the Israeli army, and they kind of leave there, and then they start a lot of companies. So there were a lot of companies started there in the mid to late 90s, early 2000s. There's still a lot of companies out of there. I mean, Waze came out of there. Actually, I took Noam Barden's prior company public, and then he went on to start Waze and sell it for a nice chunk of change to Google. But my other partners, one ran Europe and the other ran Asia. So we do a number of cross-border transactions, NEC's purchase of Blue Danube being the most recent. And all the MDs were experienced senior bankers with 20 plus years of work in both capital raising and M&A. We're headquartered in San Francisco, but they're folks in New York and Palo Alto, which is where I am. And our close rate is typically very high when it comes to M&A. Conrad, you can go to the next slide.
All right.
Lenny?
So I'll do it. All right. So let me talk a little bit about preparing for an acquisition. There's the players, and then there's the cadence of what happens. But let's first go the players. Obviously, if you're on the sell side, you're the seller. If you're on the buy side, usually private equity or corporates on the buy side, and then you have your advisors such as John, an investment banker, and other related financial advisors. Usually, your CPA is working with you. Obviously, firms like us, Flatiron as counsel. The financial advisor is not just your CPA. Sometimes the investment banker does a significant amount of financial advising on the transaction. You may have specialty advisors as well, beyond just your regular accountants. For a lot of companies, their accountants might be great with regard to their filing of their taxes and their day-to-day work, but they don't know M&A. We urge many of our clients to retain counsel and retain specific accounting assistance to advise them on how to handle an M&A deal. And then there are experts, depending upon the complexity of the transaction. There may be IT, security, privacy, certain regulatory experts, or real estate experts and the like. When you're doing your transaction, you know your business, but you might not know every element of the business as it relates to certain things. And you may be relying on all those experts. You're going to have to bring them to bear for your transaction. A note on size. Size matters, but it's not really what you think. The point really is that public companies have a different set of due diligence. You read about these deals in the paper about, big company buying big company. When they're public, all their information should be public if it's material. Middle market M&A deals are different. There's a significantly large component of the transaction. That's the diligence, and the rigor with regard to that diligence is extremely intense. And we'll be going through that today as what you have to have ready for your acquisition. But it's the middle market suffers more in the diligence period than sometimes many public companies. Public companies have regulatory issues. They have other issues with regard to their transactions. They have significant regulatory issues due to their size. But from a diligence perspective, you're going to go through a much deeper examination in a middle market company than a public company. So what's the process? John's going to go through it in detail with regard to some example transactions, but from our perspective as counsel, it's sort of like a 6-act play, the way I lay it out. There's the canvassing, and John's going to go through that in detail. Finding the partner, the act of dating, which is offering your documents and showing some financials and a business synopsis and the like. That's usually put together by your banker. Picking the right one. You have an engagement, is my analogy from the dating world. That's your letter of intent that comes in. Sometimes people call it a term sheet. Other people call it actually, when it's preliminary, it's an indication of interest. But the most important part is it's a letter of intent. And we'll talk about that a little bit more later. It's a non-binding letter of intent. Not until the deal's closed is it going to be binding. But there are certain terms in the letter of intent that will be binding, namely the lockup period, the period of time in which you agree that you will not go and seek another party. If you're on the sell side, you're not going to go find someone else, and the buyer as well. Then there's time to meet the family. It's not really meeting the family, but they're digging into all your dirty laundry. They're going to see the basement. They're going to see the attic. They're going to see everything in your business that you have. And then you get to the vows. The vows are what you're going to say at the altar. The vows are what you're going to say in your agreement between you and the other side. It could be a stock purchase agreement, an asset purchase agreement, a membership interest purchase agreement. If you're an LLC, it doesn't really matter. It's the legal doc that our firm and others will be working on. But there's a subplot in there, the representations and warranties, that what you say will be verified by statements of you as the seller, you're going to be personally liable for many of the statements that are stated in those representation of warranties. The old maxim is caveat emptor, buyer beware. Well, buyers have been burned, so it's trust but verify. They'll take your word in a business meeting, then they're going to pound you with reps and warranties to make sure that you stand behind everything that you've said and everything you've produced, that it's accurate and honest. And if it's not accurate and it's not honest, you're going to be paying dearly for it later. Reps and warranties sound like they're repetitive of the diligence. They are, but they're not. They're completely independent. They may cover the same areas. They may ask you the same things, but now, and rather than just produce the document and say, hey, look, we gave it to you, you're making a representation that you have to stand behind with your fortune that you received in the deal, and potentially more liability beyond just the fortune that you put up in the deal. And then finally, there's the honeymoon period, which is post-closing integration. That's when the real truth comes out. You say you could do this, particularly if you have an earnout. You're looking to earn some money and make some certain things happen. The post-closing integration and the earnout are critical elements. John will be talking about those again today.
Earnouts occur when there's a difference between what extrapolation of your past revenues and EBITDA would suggest, and what you're saying you're going to earn. So if you've been, producing 10% growth in revenue every year over year, and all of a sudden you go to 100%, that's why you would have an earnout. It's basically to show, okay, we believe you, but prove it, and we'll pay you when we see that. So that's why when earnouts typically show up.
Right, and it's significant if it's a significant component of the deal. You're at risk. Like for example, you cut the deal in 2022, and your earnout's going to go through 2023, and there's this nuclear winter that you're living through today. It may be very, very difficult for you to meet that earnout because your expectations were high in 22, and they're awfully low in 23. So John will talk about that a little bit more later. One last point here. Privacy, cybersecurity, intellectual property, and other regulatory issues similar are enormous issues in private company deals. If there's a lurking issue that there might have been a leak, a security breach, if you don't have your IP tied down, we'll talk about that later as well. The volume and sophistication of diligence requests and the reps and warranties that go with them is multiplying. It used to be that they were 5 pages of requests. Now it's 30 pages of requests. We've had deals with 600 individual diligence requests on transactions that are, between $50 and $100 million. They're not, multi-billion-dollar deals. And we've seen reps and warranties going into the 50 pages long. It's somewhat ridiculous. They're always repetitive, but when you're on the sell side or on the buy side, people are just nervous about ticking and tying every single thing. In regulated sectors, healthcare in particular, financial and otherwise, the diligence is brutal on the sell side, and it's very detailed on the buy side. So keep that in mind as you get your head around the idea of getting ready for a transaction. So with that, John, can we talk a little bit about what more detail about what a company should have in place if they really they want to sell?
Yeah, so from a high level, you need to have, all of these elements in place, prior to going out and soliciting interest. And, in general, companies are bought, they're not sold. So it's nice to have some inbound interest. It's nice to be in a vertical that's hot, that other folks know of you, that perhaps your business is causing pain to a larger entity. And so those are things that help in terms of both your metrics and your projections. But financial statements need to be pretty buttoned up. We're in a situation right now where I represent the buy side. We submitted an LOI actually above what I knew the potential seller was interested in. They don't have audited financials. We ended up talking to their quote controller, which was an outsourced CPA firm, and they presented us financials that were pretty wonky. So you really need to get these things buttoned up beforehand. It helps to have a finance person because they're going to be providing that information. You as a CEO don't want to do all of this yourself, because you got to run your business as well. And we're in another sell side process of a company that's in a pretty hot space, influencer marketing, and their CFO is taking a month to revise their projections, which I've gotten 2 interested parties who've already signed NDAs. They've been waiting for 3 weeks already. It's going to be another month. That is not good for the process to have to, keep these guys who are anxious to look at it, and they're both private equity firms, to be waiting. You do need, so having audited financials, or at least a quality of earnings, is what's necessary. Historical 2 to 3 years, and projected, 5 years out is I think most people discount 5 years out, but at least 2 to 3 years out would be necessary. And then in terms of projections.
And John, before you get to projection, can you just elaborate a little bit more on quality of earnings? Because people throw the word around, and a lot of people maybe in the audience might not really truly understand what it is.
Right. So there are firms that provide, if you don't have audited financials, that provide what are called a quality of earnings review, and they will submit the specifics about how your revenue recognition is, all elements of the profit and loss statement, your income statement, the balance sheet, and so on, so that the buyer has comfort that they can rely on the financial statements. And that takes about anywhere from 3 to 6 weeks. Sometimes it could take 2 months to get done, depending on the complexity of the process. And if you have a pretty simple P&L, then it can be much shorter and much cheaper. But it ranges from 30, 50,000 to a couple $100,000, depending on what it is, and again, the complexity of the financial statements.
Thanks, John.
So regarding projections, the more detail you can provide, the more comfort you can provide a potential buyer, the better off you are. And particularly if, like I said, you're going from 10% growth to 50, 100% growth. If you have a pipeline of either signed contracts or POs or subscriptions that you show, or you have them in a certain cohort of that you can assign a probability to. In other words, if they're ready to sign the contract, you put them at 75, 80% probability, and you assign a probability weighting to that revenue. The more detail you can provide in your projections, the more comfort you're going to give a buyer, the less they're going to require an earnout on that. And you want to lower the earnout as much as possible, because once you are inside of another company, you have significantly less control over your business than you would standalone. So we always advise our sell side companies to try to, we try to limit the percentage of the earnout. Some verticals like IT services and BPO companies, it's normal course to have a 2 to 3 year earnout, because that's a service business. Service businesses, the assets walk out the door at night, and you cannot be. There's no way for you to predict whether once a deal gets done, they don't move somewhere else. So you really need to have an earnout in those businesses. And I'd say, I've seen anything from 50% upfront at close to 30% to 70%. It depends again on the comfort level you can give the buyer and how much they really want your business. And so it's incumbent upon the seller to make sure that you can deliver on those projections. Business metrics similar, that they need to understand the KPIs that drive your business model, so that they can do sensitivity analysis on those. And there are black swan events like COVID that you just cannot predict, but normal kind of business cycle elements can be predicted and can be you know, help to allow you to garner more in terms of you know, end result. And you know what you want to be able to convey is what's your unique value proposition, what's your secret sauce, why are you better than your competitors. And then finally is the documentation, which you know is going to end up in a virtual data room, and we help. You know, the more you have already in a virtual data room, the easier it is to collect. And that's again, you want to have a finance person, you want to have other folks, your legal, et cetera, team pulling those together, so you don't have to do it at the last minute. Next. So this is, you know, kind of an overview of the M&A process. Typical timeline is 6 months. I'm going to go through it in much more detail in the next slide, but it's really broken down into those 5 elements, which is the prep, the marketing phase, solicitation, negotiation of offers, and then you move into exclusivity with one potential buyer, and then go to confirmatory due diligence and sign and close. But the next slide will go into significantly more detail. So this is, you know, a typical process. 6 months is, I would say, a typical process in a normal environment. You know, unfortunately, the deal that Conrad and I did, he was in it at the last part of it. That took a year because we kicked it off in March of 2020, and so right as COVID hit. So it was like the worst time to kick off a deal. But you know, we kept at it and we got the deal done. But the way it starts is, you know, after you select your bankers, you sign the engagement letter, we send you a due diligence list that's necessary for the org meeting, the organizational meeting. And that's where a full team from our side and a full team from your side, you know, the people who are in charge of finance, legal, marketing, sales, CEO, et cetera, are in one room. You tell us your story once so we can go back and draft the documentation. The documentation will consist of a SIM, which is a confidential information memorandum. Those things used to look like an offering document, a public offering document like an S1. They now look more like a deck. And so they're more commonly referred to as SIPs, confidential information presentation. And all of that work under preparation and pre-marketing is kind of done in parallel. So while, you know, after we get your story, we start drafting the SIP. We start also working on the model, the financial model with you, if it needs work, because we want to be able to make sure we know where the KPIs are and the triggers are, and we can defend it. Because we're going to be doing all of the initial conversations with all the potential buyers first. Our job is to make sure that the CEO and their team run their company and that they don't miss any numbers, because that's the worst thing to happen in the middle of a process. And so we draft from the SIP, we draft an executive summary. That's what we go out with to potential buyers. We're also drafting the list of potential buyers, which we end up tiering. So there's a, you know, first tier, second tier, third tier. It depends on the vertical you're in. It depends on how many competitors you have. It depends on whether you're going to go out to your competitors. But, you know, there are typically two major groups of buyers. One are strategic buyers, and then a subset of that is your direct competitors. And then there's the private equity or growth equity guys. And so sometimes we do a first round and second round, sometimes we just do one round. Typically the strategic guys take longer because you're one of many deals they show. I mean, Salesforce used to be a very active buyer. They haven't bought anything this year, which is why, you know, M&A is kind of at a low point right now. But you know, they used to have, you know, a tiered set of potential deals that they would do. So you got to get in the queue effectively. The more you can get into the specific decision maker in that whatever the SVP or VP in charge of that group is, the better off you are, because then they'll go to the corporate development guy and said, you know, move this to the top of the list. But we end up touching these potential buyers, sending out the exec summary, getting NDAs signed. Once the NDA is signed, then we share the confidential information memorandum or presentation, and we go through, good thing that came out of COVID is everything is done online. It used to be we'd kind of do roadshows, but now we can compress the amount of presentations and do them online. And we'll certainly do that with the first round. And then they'll come back and ask questions. What we'll do is try to figure out if we're getting interest. We're not going to distribute bid letters until we know we have interest. And so a process letter tells them what the process is going forward. That's what the bid letter is. And so once that occurs, let's say the first round is strategics. The second round, toward the end of the first round, we'll start to reach out to the private equity guys. The reason why we don't need to reach out to them initially is because this is what they do day in and day out. They can come back and they can respond very quickly. And so, they're able to make decisions at a much rapid pace and come back to us with questions and sessions very quickly. They have a team assigned to that, just like we have a team assigned. And so at the end of both of these, first and second round, or if we do 2 rounds or just the first round, we'll send out bid letters. We'll get a list of entities that give us a range. We tell them exactly what we want to see. We want to see a range. We want to see how you're going to finance it. We want to see if you need approvals, et cetera, et cetera. Sometimes we'll also send out we'll have a markup of the definitive agreement. And so that may be a factor in who we choose, because if somebody's going to come at us hard with a big markup versus somebody who's going to be much more agreeable, we may go with the easier one if their valuations are about the same. And excuse me. And then finally, we go into exclusivity with one party, and that goes into confirmatory due diligence. It goes into, and that's when the law firm will be in kind of throughout. They will have chosen Lenny and Conrad to help them throughout, but they really are involved when it comes to the marking up of the contracts, and then I'd say, you guys tell me, but the majority of your work is done in that final due diligence and negotiations phase. Yeah.
We try to get involved at the LOI level because we tend to be very heavy in the LOI to pin, particularly where there's an earn-out involved and some other nasty issues. If there's going to be issues with regard to further employment,
right.
Key personnel, and so on and so forth. The LOI is actually a critical document that many lawyers don't even touch until it's too late. And matter of fact, those clients who've signed it first and then come to us, we're always saying, okay, we'll work with it, but you missed a couple of major points, and we'll wind up fighting it for it in the master agreement. But right. And then the other big piece is going through the diligence, and that's, we'll talk about that later on when we use our deal driver process to bubble up information as early as possible in that process during diligence to avoid some no-go decisions later on. So we'll talk about it later.
And so this timeline again is typical. It's subject to a bunch of factors. Probably the most important factor is if you have inbound interest. So if you've had people pinging you, and by the way, some private equity firm sending you a letter saying we're interested in your company is not inbound interest. They hire kids right out of college, and all they do is bang the phones, and then they send out emails, and that is not an inbound interest. Inbound interest is when somebody says we're interested in acquiring you, and if you've had serious discussions about that and they've mentioned numbers, that's inbound interest. That will accelerate a process. It could be, months instead of 6 months. It could be 2 to 3 months. That has been as short as that. The other one that'll accelerate a timeline is if you're in a very hot space, and that you're killing it with your revenue and you're beating your numbers every quarter. That will accelerate a timeline as well.
Hey, John, if your principal competitor has come to you with a number and then the client comes to you. Is there still value in bringing you on to into the picture at that point?
Yeah, well, just that's actually what the next two slides are about. So good, good setup, Conrad. So why choose a banker? We've had a lot of people come to us. We got hired actually after for a company that does retargeting and marketing in the Valley, and we had done a lot of those marketing software transactions, and we got hired by we had just sold the company. We got hired by a competitor after they received an LOI from a large publicly traded company. I mean, this was AOL at the time, which got sold to Verizon. Verizon Media now stands alone as Yahoo. And actually, the head of corporate development at Yahoo or at AOL at the time it really was totally against us getting hired. But as the weeks went on, he realized that we really added value because we were able to help the company with the financials, help the company with the due diligence requests. We accelerated the process in his regard. And so, the reasons to choose a banker, and I'll go into more depth in the next slide, is really, if you're going to end up with this buyer, you don't want to have a bunch of difficult conversations that may leave a bad taste in their mouth when you're negotiating either the value, the structure, the timing, or any elements of due diligence. We're able to be a disinterested third party in the middle of that, and you can throw us under the bus a whole lot easier than you can repair what may become difficult conversations. Additionally, we can help both prior to going out as well as during the process optimize the company's positioning for sale. We're actually pitching a company right now who was told by one banker that they should position themselves as an IoT company. They're really a comm software company, and that fell very flat to potential buyers. They fired those bankers, and now they're interviewing other bankers, and we're pitching on them. And we told them, look, people get it. They don't need to have you present yourself as an IoT company when you're really not. And so even after you get an LOI or an IOI, or you get some inbound interest, the benefits of using a banker is, the most important one is time. You cannot afford to miss your numbers and endangering your process, and that's the most underrated reason why to hire a banker. We manage about 80% of the transaction work, which gives the management team critical time to focus on producing positive operational results. We manage the day-to-day process, as well as providing our expertise on running a bespoke process strategy. And we offer more than just process insight, but we work with our clients to develop a long-term strategy for their success. And preparing the company, we advise, we don't want to go out immediately sometimes. I mean, sometimes there's a lot of prep work to be done, and to perform kind of front-end due diligence to make sure that all your ducks are in a row. The investment bankers, know what materials and documents need to be ready before, the questions ever get asked. And sometimes there are obvious things that we need to address, that there are certain things that we know a buyer are going to ask. And so we have potential questions and answers as a standalone page or multiple pages to go through. And then, we live and breathe these transactions every day. We know what to expect. And as I said, kind of proactively coach our clients toward a successful outcome. And, adding credibility to our client. You don't hire an investment banker unless you're serious about selling your company. People know that if you hire a banker, you hire M&A attorneys, you're serious. Sometimes people are kicking the tires. We had one entity, I'm on the buy side for this one, where we submitted an LOI. The CEO said he was interested in a certain number. We actually had a range that surpassed that number, And then he's gone radio silent. So he doesn't have a banker, he doesn't have a lawyer. He was just kicking the tires. So having a banker represent you adds credibility to the process. And identifying, contacting buyers and investors. M&A is very important to hire a banker who knows your space, because we have talked to the same buyers and investors that you're going to want us to talk to. We know the heads of the vertical inside the company, who's the decision maker. You don't just call up the CFO. You don't just call up the head of corporate development. We know the people to talk to, and we get to the right people to review the opportunity. And that increases the odds of something getting done, or at least getting a serious look, because that's what you want. And then, finally, negotiating the transaction, deal insurance. We've seen all sorts of negotiation tactics. We know which positions we need to take on behalf of the client. We watch out for the other side. This is what Conrad and Lenny do all the time. And we've run hundreds of processes like these. We come into a whole lot of every conceivable problem, and we use that to turn into some potential problems into an advantage for you, as well as do Conrad and Lenny.
Hey, John, just we got a question from a guest. Are there any nuances to be aware of when it is an asset sale versus a stock sale? Let me take a quick pass at that, John, and you can comment.
That's a tax attorney question, so I'll let you
that goes back to what John said, which is negotiating the transaction and using your banker to do that. We can in fact do separate webinars just on structuring transactions. I mean, the short answer is that the structure of the transaction is going to be economically critical to your economics. As a general rule, an asset sale is going to yield you a higher price because the buyer is getting more tax benefits, but an asset sale may not be economically feasible for the seller, depending on how the company itself is structured. If it's a C Corp, for example, it'd be very difficult. But that's the kind of thing that's a significant economic driver that gets flushed out in the first instance by John, and the second instance by us at or around the letter of intent stage, John.
Right. So this transaction overview is effectively a summary on the objective side of what I went over. Our job is to, identify, by the way, in discussions with you as a seller, what the most ideal partner or the most ideal transaction would be. Do you want to get another bite of the apple? Do you want to sell a majority piece? Do you want to sell a minority piece? If you sell a majority piece, how much do you want to keep? And do you want to sell it to a private equity firm who could fund you, who could then help you with acquisitions and so on? How to get sometimes a premium valuation is not the most important thing for a seller. Sometimes being in the right with the right buyer is the most important thing. But time is again one of the things we try to make very efficient use of management's time, because we last thing again we want to happen is you miss your numbers in the middle of a process. And then the ideal transaction from financial and structural perspective. Again, I talked about this. The potential buyers right now, there are no strategic buyers, frankly. The combination of interest rates going up, the market going down. When the market goes down, the public companies' currencies go down. They don't want to signal to the market that they view their public currency as a good currency to use to do M&A. So they'll use only cash. So that means they only have one way to pay for a potential acquisition. But typically, strategic buyers are going to pay a premium because they can get both not just revenue synergies, but expense synergies out of that. Private equity can also do that if they have a portfolio company that is in your space and they would like to to buy you for that portfolio company. Sometimes they'll buy you if you're large enough as a standalone asset, but you have to be, depends on the private equity firm. Some mid-market private equity firms will go as low as 2 to 5, 10 million EBITDA. Some will start at 25, 50 million EBITDA. So if you're that large, you're looking at the very large private equity firms. But the thing about private equity now is there's a lot of dry powder. They're still very active. VC cash is actually contracting. They're not getting as many, raising as much money as they have been recently, but the private equity firms are still active. Of the 12 tech deals that were over $1 billion in the first quarter, 9 of them were done by private equity, 3 by strategics. And of all the tech deals done in the first quarter, 2/3 of all were done by private equity. And so those are the guys who are still active now. I expect that to turn around once we settle out here. The SVP situation definitely upset a lot of folks, but that's despite people's feelings about whether the Fed should have rescued all of the depositors or not. I think that did help, and we would have had a big but a lot more layoffs if they had not come and guaranteed those. And finally, transaction structures. I kind of alluded to that. 100% sale, majority sale with shareholder role, which is where you sell a majority over 50.1%, but you're wanting to get a second bite of the apple. So you keep a significant portion. And then there's the minority investment, which is a cap raise.
And John, occasionally if there's a private equity buyer, he may want you to reinvest some of your proceeds back into the platform company.
Well, actually, most of the time they would want that because they don't want you to throw the keys over the fence. They want to make sure that you feel as confident about your company that you're selling as they do buying it. And if you don't roll over, you got to have a good reason why not. Why you're not.
And John, it's not necessary. It's a lot of times it's a good deal. You're coming in at the same price as the investors and the funds. So it's a lot of sellers are looking for that.
Yeah.
Okay, so let me throw a wet blanket on stuff for a little while here. So, why do deals fail? John was talking about, buy, sell, things look good, although the market right now is pretty bad. Generally speaking, we got to think about, well, what are the obstacles that are going to get in the way? What's going to cause you to fail if you're in this track with John or any other banker? The first thing to recognize is that you're unfamiliar with the process. One of the reasons that, for example, you should be hiring a banker and have CPAs that are familiar with the M&A process, have counsel that are familiar with the M&A process. Unless you're a really successful serial entrepreneur and you've done this multiple times, the entire process is strange to you. And you have to recognize that and utilize the advisors to get you through it. Another is unrealistic valuation expectations. John can talk more about this if he wants, but owners are, by their nature, if they're entrepreneurs, somewhat egotistical about their business. And today, if they're looking for a valuation, it's very different than it was in 20 or 21 or 22 even. The market has changed dramatically, and the valuation numbers are significantly more reduced than they were in the prior 3 years.
And we actually don't get involved in a process where the major shareholders have unrealistic valuation expectations, because we get paid 90 to 95% of what we get paid is on a success fee. We have I see somebody asked about, fees. The way we structure it is we have a retainer. If it's 10% of the total success fee, that would probably be on the high end. And so 95% of what we do when we allocate a full team, we have a managing director, sometimes 2 managing directors. We have a principal, we have an associate, and we have an analyst. So that's a lot of bodies that we're paying for on the expectation that we're going to have a successful outcome. So if somebody's, wants a, and I was on the phone with a CEO the other day that had a chatbot company, and chatbots are super hot now. AI is super hot, and he was doing less than 5 million in revenue. And he thought he was worth 250 million. I said, well, good luck to you. I'm telling you that that's probably not what you're going to get, but maybe you should talk to some other folks about that. But that's a deal breaker for us, and because we want to know that the shareholders are going to take what the market will bear. And what drives valuations is a diversified customer base of blue chip customers, greater than 20% year-over-year annual growth, attractive margins, products that can drive immediate ROI, and what constrains valuation is customer concentration, flat or declining revenue growth, high cash burn, no visibility to profitability or no visibility to revenue, and difficult long implementation of products, etc., and a very highly competitive market. So having unrealistic valuation expectations will kill a process.
And John, the corollary to that you and I ran into in our deal last year is to make sure that all your various stakeholders are on board. When there's a corporate governance process, you have investors, you have legacy stockholders, you've got management, and all of them have effectively an implied veto right over the transaction. That can delay the transaction, that can make the transaction, that can spook the buyer. And we had to go through, even though it was a small deal last year, you and I, we had to go through essentially a proxy, a contest to get everybody on board. And that if you don't have your ducks in a row, that can be fatal.
So, and I'll talk about that a little bit in the next slide, but it's all part of the being prepared. Preparation, it says on the bottom here, it's preparation. Yes, there is that instance where someone comes up to you, makes the offer, it's a real company and so on. That is the rarity in terms of closing deals. Most of the time, it's a significant amount of prep, significant amount of work to make sure everything is clear and clean. And we'll talk about that on the next slide about how some other obstacles.
And Lenny, John Torres asks, what percentage of buyers value recurring revenue compared to transactional sales?
Yeah, well, recurring revenue is SaaS revenue, recurring revenue, subscription revenue is definitely more highly valued than license revenue for software and transactional revenue. So the numbers change as the markets fluctuate, but it's definitely more highly valued.
Yeah, they want the sticking
because it's recurring and repeatable and referenceable to a certain extent, because they're voting with their dollars. They're sticking with you.
Lenny, move to the next slide. We only got a couple minutes.
All right, so cleaning up our messes, cleaning up your messes, okay, before you go to market. It's don't give a nice buyer an opportunity to walk away, like what Conrad just talked about. Look at your governance table, your cap table, whether they're investors, they're friends, you have phantom stock offerings, whatever. Clean all that up. Make sure, we've had instances, make sure that the management team is actually in control of things, that the owners actually run the place. We've had management teams that handed over control to, we'll call it non-owner management, and they controlled the direction of the deal, and they trashed 2 deals on the way to a third. That's so clean your house up, clean up your title if you have intellectual property, both inbound and outbound. Did you give away the shop to somebody, or have you not cleaned up that your consultants that work for you? And watch out for showstoppers, or I call them show slowers, change of control issues, assignment issues, cybersecurity and privacy breach issues, sales tax issues. It's amazing the number of companies out that have not gotten good counsel with regard to whether they should be collecting sales tax, even on SaaS products. Most people think, well, it's all online, there's no sales tax. Most jurisdictions around the country have realized that they've lost that old license or software sale box that's delivered to somebody, and they've changed their rules in many jurisdictions nationwide and require collection of sales tax on SaaS, which most people are surprised to learn. But and there are firms that are specializing in this and helping people out. But to find that out, in your transaction, you're going to take a major hit in an indemnity obligation. And then if there's litigation claims out there, whatever they may be, threats or otherwise, get them out, get them early, tell your counsel, tell your banker, and let's learn about them so that it doesn't slow the deal or even kill the deal. One of the things that we do to make this a little bit easier for, particularly for the sell side, is that we built a platform that we call it Deal Driver. That's it's our platform. We wrote it, we built it, we run it. It organizes the diligence and it bubbles up information with regard to every single document in your repository. All metadata is extracted from every document, and it bubbles up these issues, these questions very early on, both to your management team on the sell side and to the buy side. If you're really going to do the deal they want to see, and then you can negotiate a way around it. Our platform comes from doing deal after deal after deal and bumping into problems for middle market companies. And rather than hope and pray that the deal closes, let's get all the factual information up. Let the buy side see what's going on. Let the sell side know what they're putting on the table, and move it forward. It's more sophisticated and much more involved than a regular VDR or virtual data room. We actually extract the information from every one of the documents that's posted, put it up there, have a matrix about all that information. If you want to talk to us about how to do it, a bunch of clients now, more recently, taking a key from John's playbook, they work with us before they get an LOI, before anything else, and they clean up their house using our platform. We help them get everything ready before even they're talking to the selection of their banker, or we work with bankers and their clients in cleaning things up on a platform. And the buy side really appreciates this because everything is transparent. Everything is much easier for them to slice and dice. And that's both on the financial side as well as all the underlying legal documentation. We've had deal after deal where you don't have contracts. All you have is purchase orders. Not a problem. But if it's an organized presentation of all those POs and whether they have extra terms or not, it's a much easier sell than it is to say, well, you don't have any contracts with any client, and so therefore you don't look as good as the person who has those contracts. We can make it look better by showing all the details, and that's what our platform does. So with that,
all right, Lenny, we got 157, John.
Yeah, I'm not. This is self-explanatory. I'm going to say we move to questions because I've basically touched on almost all of these points anyway. This is kind of.
And by the way, we're sending these slides out. Actually, a much larger deck than what we went through today. It's about another 15 pages, so it's a 30-page deck that John has prepared and one that we had prepared. We couldn't go through it all, so everybody will get the benefit of that if they're on the call. Yeah. So with that, some more questions, Conrad?
Well, my daughter just commented that I have more hair than the two of you.
That's a low hurdle.
It's not the first time I've been told that, by the way.
And I don't have that much hair.
No, you don't.
So guys, if you want any questions, we'll stick around as long as you want us to stick around.
Yep. Yeah, I've got time after this as well. So Bill had a question about the banker structure of the fees.
Yes.
I touched on that a little bit. The retainer is basically so that the seller has some skin in the game, or if it's a buy side, it's a retain, and it's typically a monthly retainer. Sometimes it's capped, sometimes it's not. If it's a buy side, I typically try not to cap it because a buy side is a black hole. You can work on it for months and months. And I had one client who I presented them 3 different deals. They got acquired by their competitors. They never pulled the trigger because the CEO just didn't want to do it. So you got to get paid for your resources. But the majority of the success fee, typically, if it's a sell side, it'll be a percentage of the total consideration, the enterprise value. And it depends on Goldman Sachs, they're going to have a $5 million minimum or more, and they're going to have much higher fee structures. Mid-market banks are going to be, my former bank, Piper Jaffray, probably has now Piper Sandler probably has a $2 million minimum fee. Our minimum fee is just under $1 million. So, and then there's a structure which is a percentage of the total consideration. And then there's a tail involved and expenses, but expenses are typically just travel. So that's it. Those are about the key points of an engagement letter.
Yeah, and from the Flatiron perspective, I know we price ourselves on a fixed fee basis, which is subject to lots of variables. The principle of which is timing. I mean, how long it's going to take from the point we're engaged to the closing. But there's a lot of other factors involved as well, you know, including the volume of the data that you need to produce and the complexity of the deal. And then we start diving into earnouts and into working capital adjustments and other things. You know, that can, as a general rule, we're typically 40 to 50% cheaper than the counterparty big law firm, and they typically charge 3, 4, or 500,000. So we're considerably cheaper to them, but it depends on the transaction itself.
Right, and the last part of the question is are the fees negotiable, and does that happen? Yeah, unfortunately, it happens all the time, and but you know, there's a point where if we have a lot of bandwidth, then you know, maybe we'll take the hit on some of the negotiated terms. But if we don't, then we're not going to. You know, we're going to stick with it, particularly if we think it's a very complex deal, and if it's in a space that we know. And can really help the company. But you know, we typically don't lose transactions based on negotiating fees. You know, I think the other side is you know, they go after that, and we're typically fairly flexible.
All right, Lenny, you want to wrap it up?
Again, everybody will get a copy of the various decks that John's company and our firm have put together. We'll send those out within a day or two. This recording at some point will be edited and will be posted, but most people don't really watch the video a second time. So, but maybe your friends will want to watch it. I want to thank John, our esteemed guest, for his time today, and I thank everybody for showing up and spending some time with us. If you have any questions for John or people at Flatiron here, when you get the emails from us, you'll have the contact information to reach out to any of us. Please reach out. We'd love to talk to you. Thank you all.
I'll stay on a minute or two if you guys want to do that. See if we have any other folks.
Sure.
We're getting a lot of thank yous.
Yep. And Lenny.